The idea of using private assets as a tool of state policy is simple to state, but difficult to fully comprehend. At its core, it means a government can seize or freeze assets, owned not by another state, but by private individuals and companies. It can block their access to the banking system. It can compel large corporations to surrender funds or redirect payments. In the turbulent years of the 2020s, this concept evolved from a theoretical threat into a tangible policy instrument, one some have labeled forced reparations. This practice is a merger of law, finance, and geopolitical power. This essay will examine the long-term consequences. It asks, what does this mean for the future of the US dollar and the euro? What happens when nations begin moving vast sums of money to shield them from potential seizure? And will this make the world more stable or usher in greater volatility and risk? First, we must be precise about what we mean by private assets used as a weapon. These are assets not owned by a foreign state, but by its citizens or corporations. They include bank accounts, corporate stock portfolios, bonds, real estate, industrial plants. A state might act to block the use of these assets, effectively freezing them in place. It might go further, using its legal system to demand payments from these assets, as a form of compensation for perceived harms. It could even use its courts to force the sale of these assets to satisfy such claims. When this happens on a large scale, it fundamentally alters the calculus of trust. And in the world of money, trust is everything. A currency is only useful because people collectively believe in its stability and the reliability of the system that underpins it. If that trust begins to erode, the currency can rapidly lose its privileged status as a global store of value and the primary unit of international trade. The US dollar and the euro stand today as the main pillars of the global financial architecture. Their dominance rests on trust from countries, companies, and individuals in US and EU institutions. Their banking systems are vast and liquid, offering unparalleled access to capital. Their legal systems, for all their imperfections, have long been viewed as stable and predictable. The dollar, in particular, is the most widely used currency for international trade, and as foreign reserves held by central banks around the globe. The euro serves as a powerful regional alternative and a significant global player. However, if either of these giants uses private asset seizure as a frequent political weapon, it will change how the world perceives the safety of holding their currencies. The foundation of any major international currency, particularly a reserve currency like the US dollar, is not just economic might, but a perception of unwavering legal and institutional stability. Nations, large corporations choose to hold dollars not merely because the American economy is large, but because they believe the rules governing those assets are predictable and sacrosanct. They trust that their money once placed in a U.S. bank or invested in U.S. Treasury bonds is subject to the rule of law, not the shifting winds of political expediency. The use of private asset seizures as a state policy tool directly attacks this bedrock of trust. It introduces a new, highly unpredictable variable into the financial equation: political risk. Suddenly, the safety of one's assets depends not just on market forces, but on the state of diplomatic relations between one's home country and the United States or Europe. This erosion of trust has specific, tangible consequences. The first is what economists call currency substitution. This is the process where individuals and firms start using a foreign currency alongside or instead of their domestic currency. On a global scale, it means central banks, multinational corporations will actively seek out alternatives to the dollar and the euro for their reserves and trade settlements. If that asset is no longer seen as perfectly safe from political interference, the fundamental calculus begins to change, forcing a worldwide search for new safe havens. A second long-term consequence is the rising cost of global finance. When a new layer of risk is introduced into any system, participants will inevitably demand compensation for bearing it. Banks. Financial institutions will face a host of new compliance rules, forcing them to constantly assess the political risk associated with their clients and their transactions. This will lead to higher fees and wider spreads. Corporations develop complex and expensive legal and financial structures designed to shield their assets from potential seizures in different jurisdictions. All of this adds friction to the gears of the global economy. More friction means slower international trade, more expensive cross-border investment, and a less efficient allocation of capital around the world. Finally, the weaponization of private assets risks triggering a dangerous cycle of legal and political fragmentation. If one major economic power, such as the United States, makes extensive use of this tool, it is almost certain that other countries will respond in kind. Some may retaliate by mirroring the practice and targeting the assets of companies from the originating country. Others may enact defensive laws, creating legal firewalls to protect their own citizens and firms from foreign seizures. This behavior leads not to a stronger, more just international system, but to a chaotic patchwork of conflicting national laws. In the face of such uncertainty, investors tend to do one of two things. They retreat, moving capital to perceived safe havens, or they simply stop investing in regions they deem too risky, starving them of needed capital. That shift would raise borrowing costs for the U.S. government and for countries within the Eurozone, making trade more complex and expensive. The central question: what are the long-term consequences of this policy? The U.S. dollar and the euro have long been the twin pillars of the international monetary system, but their positions are not guaranteed. They are maintained by economic strength, deep financial markets, trust of global participants. When policies like the seizure of private assets become normalized, this trust is put under immense pressure, threatening their dominance. The dollar's role as the primary reserve currency grants America an exorbitant privilege. It can borrow cheaply in its own currency and exert influence via control of the global financial plumbing. Policies that push other nations to seek alternatives chip away at that privilege, with long-term consequences for the U.S. economy. The first sign would be a gradual, persistent decline in demand for dollar assets from foreign central banks. For decades, countries have stockpiled U.S. Treasury bonds as reserves. If major holders such as China, Japan, the oil-producing states of the Middle East start reducing dollar holdings out of political fear, the U.S. would have to offer higher interest rates to attract buyers. That means higher borrowing costs for the U.S. government, American corporations, and ordinary consumers, mortgages, car loans. It would be a slow, steady drag on the U.S. economy. The euro faces a similar challenge, but lacks a single, unified political and fiscal backstop. Its strength comes from the Eurozone's collective economic power and the credibility of the European Central Bank. Aggressive EU asset seizures would create deep anxieties among trading partners. That could undermine the euro as a stable alternative just as demand for alternatives rises. It could also create internal divisions within the EU, weakening cohesion and stability. Most global commodities, especially oil, are priced and traded in dollars. That creates structural demand for the currency. If exporters and importers switch to the Chinese yuan, a basket of currencies, or a newly created digital currency, the dollar's transactional utility would fall. This wouldn't happen overnight. The dollar's network effects are powerful, but asset seizure policies give countries the political motive to build alternatives. That shift would fundamentally rewire the global economic order. Faced with the novel risk that their reserve assets held in dollars or euros could be frozen or seized for political reasons, central bankers around the world are compelled to act. Prudence dictates that they cannot afford to leave their national wealth exposed to such a threat. Their logical response is to diversify their holdings. The Great Reallocation. This is not a panicked, overnight flight, but a deliberate, long-term strategic shift to move assets into different forms and different jurisdictions. A direct consequence of the breakdown in trust, as countries build financial fortresses to protect against politically motivated financial warfare. The primary goal: reduce dependence on any single currency or legal system. The first and most traditional destination for diversification is gold, a physical asset that carries no counterparty risk. We have already seen a notable trend of central banks increasing their gold purchases and, in some cases, repatriating their gold reserves from vaults in New York and London. While gold pays no interest and can be cumbersome to transact, its safe haven appeal rises with geopolitical and legal uncertainty. Another avenue is into currencies of other, presumably more trusted countries, where geopolitics and economics intertwine. A country feeling threatened may increase holdings of the Chinese yuan, the Japanese yen, the Swiss franc. It might forge closer financial ties with a bloc of friendly nations, creating a sphere where a different currency becomes preferred for trade and reserves. For example, a bloc might form around the yuan, using it for settlement and reserves, an ecosystem partially outside the dollar-based system. Finally, the most radical reallocation: new asset types and payment systems. Cryptocurrencies or central bank digital currencies, operating on rails separate from traditional banking. Two countries could settle trade with a jointly managed digital currency that bypasses SWIFT and correspondent banks in the US or Europe. The development is complex and risky, including cybersecurity and volatility, yet the strategic incentive is powerful. Governments accelerate research and investment in these frontier technologies as a matter of national security, which sets the stage for a world where finance splinters into semi-isolated blocks. The logical endpoint of the Great Reallocation is a world where the once unified global financial system splinters into several distinct, semi-isolated blocks. Instead of a single, dominant system centered on the US dollar, we would see multiple competing systems, each centered around a different major currency or a coalition of allied nations. One bloc might remain anchored to the dollar and the euro, another might coalesce around the Chinese yuan, perhaps others around regional powers or even non-state digital currencies. This move from unipolar to multipolar is what we mean by fragmentation. The first clear risk is a sharp reduction in market liquidity. A deep and liquid market allows large trades without major price moves. The dollar-based system is liquid because nearly everyone participates. Break the global market into regional ponds, and each is inherently less liquid. Large transactions become harder and more expensive, driving greater price volatility. Selling reserves to defend a currency is tougher in smaller markets, risking sharper crises. Loss of efficiency acts like a tax on all trade and investment, slowing activity for everyone. A second peril: smaller and poorer countries risk being cut off from global finance. Access to capital becomes politicized. Alignment with a bloc may cost sovereignty, and falling out of favor can shut credit entirely. Inequality worsens as geopolitics trumps fundamentals. Third, crises are more likely and harder to manage. Coordination, like in 2008, becomes difficult across rival blocs. With contested rules for restructuring and no global lender of last resort, contagion is unpredictable and the system more brittle. Two paths diverge. Scenarios of stability and volatility. As we stand at this crossroads in 2026, the long-term consequences of weaponizing private assets are not yet set in stone. The global community's reaction will determine we move toward a more stable future or descend into an era of heightened volatility. The outcome depends entirely on the policy choices made by world leaders. One path leads to a more fragmented and dangerous world. The other, though difficult, could yield a more resilient, balanced system. The initial shock of asset seizures and reserve diversification will almost certainly increase volatility in the short term. The critical question is what happens next. The more probable and more dangerous scenario is deepening fragmentation and sustained volatility. In this future, nations fail to establish new rules of the road. Driven by mutual suspicion, countries build financial defenses and move reserves away from perceived risk systems. New currency blocks solidify. Finance grows regionalized, less efficient, more politicized. Smaller countries are pressured to choose a side, sacrificing autonomy. Crises spread faster within blocks while the tools to manage them are weaker. This is a world of higher transaction costs, slower growth, and constant low-grade financial warfare. However, there is another, more optimistic path requiring immense political will. Leaders build a stronger, more equitable architecture. Clear, binding international laws limiting private asset seizures. Create neutral international panels to adjudicate disputes. Over time, predictable standards can stabilize a more multipolar system, governed by law, not raw power. Technology will either accelerate fragmentation or help entrench rules, depending on choices made now. The role of technology: an unpredictable accelerant. The ongoing revolution in financial technology plays a crucial and unpredictable role in this unfolding drama. New technologies, particularly those related to digital currencies, alternative payment systems, can act as a powerful accelerant, speeding up the fragmentation of the global financial system. At the same time, they could provide tools for a more transparent, rules-based order. The direction technology takes will be shaped by the strategic choices that states and powerful private actors make. How these tools are deployed will drive volatility or stability. Technology is a wild card in this entire equation. On one hand, blockchain and other distributed ledger technologies offer payment rails entirely outside traditional banking controls. A group of countries could develop a shared digital currency and a messaging system for cross-border payments that avoids SWIFT and U.S. correspondent banks. This creates a credible exit option, strengthens bargaining power, reduces dependence on the old system, and speeds the move away from the dollar and the euro. But dozens of competing systems become a regulatory nightmare and can ease illicit activity like money laundering or terror financing. Interoperability frictions raise costs. New rails are vulnerable to cyber warfare. A state-sponsored attack on a rival digital currency network could trigger crisis as surely as a bank run, fueling a high-tech arms race. On the other hand, distributed ledgers could create shared, immutable records for international agreements. Treaties governing asset seizures encoded into smart contracts could automatically enforce agreed rules. Transparent dashboards for capital flows and an internationally governed digital platform could lower transaction costs and expand inclusion, if governance is sound. Winners and losers in a new financial order. Any significant shift will create new winners and losers. If the dominance of the US dollar and the euro begins to fade as a result of policies like private asset seizure, power and privilege will be redrawn. The most obvious losers: the United States and the countries of the Eurozone, longtime beneficiaries of central positions in global finance. America's exorbitant privilege diminishes. Deficits harder to finance. Fiscal choices sharpen. The power to use financial sanctions as a primary foreign policy tool shrinks, limiting influence. Conversely, regional powers that establish credible currencies win. China stands out. Loss of trust in the dollar creates an opening to accelerate yuan internationalization across Asia, Africa, and Latin America. Other powers, such as India and blocks of commodity exporters, may also gain influence. A more multipolar world could give rising nations a greater voice in rulemaking. For smaller developing nations, fragmentation likely turns access to capital and technology into matters of political allegiance, a new form of dependence. They risk becoming pawns in rivalries, losing the benefit of a unified capital pool and facing thinner, pricier markets. Global corporations also lose, navigating competing regulations, juggling non-interoperable currency systems, hedging political risks everywhere. Doing business costs surge, supply chains slow, friction rises. Ultimately, consumers face higher prices. These shifts set up the conclusion. Does forced reparations make a more stable world or a more volatile one? Conclusion: a clear verdict and a path forward. The weaponization of private assets, as seen in the 2026 model of forced reparations, represents a grave risk to global financial stability. It fundamentally undermines the trust that serves as the bedrock of the international monetary system. By injecting political risk into a domain that should be predictable and rules-based, this policy pushes the world toward financial fragmentation. Fragmentation is likely to increase costs, reduce liquidity, and make the world economy more volatile and crisis-prone. While the short-term impact is turmoil, the long-term outcome remains a choice. A path toward a more stable, multipolar system exists, but requires immediate, cooperative, and courageous policy action. Policymakers must prioritize rebuilding trust through clear and credible rules. First, establish transparent international legal standards. Conditions for freezing or seizing private or sovereign assets must be narrowly defined, legally grounded, stripped of unilateral political motivation. Second, create neutral, international dispute resolution mechanisms with impartial panels. Third, strengthen financial safety nets for smaller, vulnerable countries. Finally, reform sanctions and seizure regimes to be targeted, legally sound, time-limited, avoiding permanent damage to the global financial commons. Final judgment. The policy of using private assets as a tool of statecraft is a dangerous gamble. It threatens to break the system that supported global prosperity for decades, creates incentives for fragmentation, and will almost certainly lead to a more volatile, crisis-prone world. This trend can only be reversed if major powers choose to exercise restraint, commit to reinforcing a rules-based order, and cooperate to build shared protections and legal guardrails. Without such effort, the erosion of trust will continue, and the world will pay a heavy price in higher costs, more frequent crises, a weaker and more divided global community. The stability we have taken for granted is not a given, it is a choice. Note: all legal interpretations, data on reserve movements, and official economic figures referenced in this analysis must be rigorously fact-checked against primary sources before publication, clearly distinguishing established facts from projections or ongoing policy debates.